Welcome everyone. So it's my pleasure to kind of moderate this session. And as Aishwarya rightly kind of opened the topic for the discussion, as you know, financial markets being powerhouse for creating wealth for brighter future, we all firmly believe in the same. In fact, we are in a business of selling dreams of wealth creation to all our clients. And obviously, we have lived this dream for ourselves more than me. You as managers definitely have lived this dream. So my foremost, question to Sunil, I can tell you, Sunil, I have come across many clients, many such friends, colleagues in this industry who kind of believe so much in equities that they still, have their personal portfolios worth maybe 20, 30, 40 crores, but they live in rented houses. Living in Delhi, and used to living in larger houses, I find it difficult to digest. But still, obviously, we understand the power of good equity investing for wealth creation. It will be very interesting to know what has been your journey over your last 2.5, 3 decades. How did you start accepting risk of investing in equities? And how do you see kind of it contributing to your wealth creation? How much do you attribute to equities to your current wealth creation?
Thank you, Kamal, for having me, and good morning to everyone. So, Kamal, I think very in short, whatever I have at least has all been created by investing in equity markets in India, directly or indirectly, as a profession, linked to the equity markets as well as an investor in Indian equity markets. In terms of how I started, frankly, I was always interested in numbers and balance sheet. And right from my student days to the days when I was doing my CA, I think numbers always fascinated me. And that is how I also got exposed to the balance sheets, because while doing audits and while, making accounts for your clients, that is when you got exposed to balance sheets. And luckily, when I completed my CA and I briefly even practiced as a chartered accountant, I had a few clients who were brokers on the BSE stock exchange. And as a young chartered accountant, when I used to go there, obviously that whole buzz was so exciting, and combined with my interest in balance sheet, I think that triggered the interest. Obviously, you had the huge boom in 92, which drew everyone in the country towards equity markets. And then as the country liberalized in mid 90s, I think, you got opportunities also, because before that it was like a closed club. It was very difficult to get into equity markets. But with the onset of liberalization, NSE opening up, mutual funds coming up in place in India, foreign investors starting to invest in India, and finally research also becoming as important or more important than it ever was. I think that was the journey which led to me getting really, sucked into the equity sort of markets as a professional. And, I think a little bit of luck. I joined Reliance when it was very small. We were like 35 crores in equity assets. Luckily, we did well. And from being the smallest, we became the largest mutual fund in the country. So I think it all worked well. So it is definitely hard work, but a lot of people do hard work. I should thank my stars, my elders, parents, as well as God for giving me what they have given. And I'm sure all my fellow panelists will also agree, and as would you, that we are lucky to have been born at a time when India has come out of age in terms of being from a very, very small economy to a top 5 economy in the world. And the tailwind has also benefited us. So I would say that for any resident individual in India, for creation of wealth, I still believe that equity has a long way to go. And if you genuinely are interested in creating long-term wealth, then you cannot ignore Indian equities.
Sure, Sunil, we are discussing power of financial markets or wealth creation. And I think, Sunil, you have opened it quite nicely. Moving on to you, Prashant, I would not ask you about your personal equity allocation because I know you have always maintained it is 100%. But, you being a global fund manager, it is pertinent to understand from you, or interesting to understand from you, how do you see Indian equity markets today and for say next 5 years in terms of its breadth in terms of the potential opportunities, risks, if compared to, say, US markets?
Well, certainly, very interesting comparison as two of the largest markets, besides being two of the largest countries. I think, see, the opportunities, breadth of opportunities, I would say outside of US, India is the only country which has such diverse breadth of investable opportunities. China also is there, but by number, a lot many more Chinese companies are, homogeneous in that sense that they're controlled by the government there. So when you look at entrepreneurially driven investment opportunities, they are in India, I would say after US, the broadest set available. Now, coming to the question of how these two markets might perform going forward, my usual position is, and no different from right now, that these markets should be expected to return. Equity market returns should be in line with nominal GDP growth plus the dividend yield over time, which is what both these markets have delivered over the extended period of time. If you look at 20, 30, 40 years, India and US have delivered very similar 5 to 6% dollar term equity market return, which translates to, say, 10, 11% rupee return. And going forward, I don't see any difference from the market per se. Having said that, I have, even though I lived in the US for 11 years, from 95 to 2006, and for most part was managing client money invested in the US, my personal money I'd always invested in India, 100% of it at the time. And the reason was not because I had any different view that Indian market would outperform, but it's simply that it wasn't that the market would outperform US market, but it's simply that even if the two markets provide the same return, let's say 5 or 6%, the Indian market alpha generating opportunity is much richer for a variety of reasons that we can go into if you like. But in Indian market, a top decile manager can generate, say, at least at that times, mid to high single digits. Even now, I would say mid single digit kind of alpha. Whereas in the US, a top decile manager would still struggle to generate 1% or 2% of alpha. So when you look at the total return, which is a combination of market return, which is, say, same, plus the alpha, then Indian market becomes a lot more exciting and can get you close to double digit or approximately double digit dollar returns, which is close to mid-teens rupee returns. But that kind of alpha generation in US is very, very difficult because of the efficiency of that market.
No, Prashant. Moving on to you, Rajesh, I'll kind of take the same question to you. You have been India-focused fund manager, and we are wanting to understand from you what are your beliefs in Indian capital market in terms of opportunities over, say, next 5 years, and why is it that you believe that kind of Indian investors should kind of expose themselves more to Indian equity markets? Is it being too patriotic thinking, too emotional thinking, or there are rational logics behind it?
Great. Thank you, Kamal. First of all, thanks for providing this wonderful opportunity to be part of this webinar. So, Kamal, I think everyone knows this decade belongs to India. There are so many reports written by global renowned agencies like McKinsey and many more such things. But there are a few important things which, as a country, we are doing in a right way. And whenever any company, or for that matter, any economy or any sector attains a particular size, you get the benefits of scale. For example, if you look at the IT industry, from 2005 to 2022, IT industry exports grew by 16 times. It is now roughly about $99 billion, 16 times. And in this period, the IT sector gained market share, almost doubled, from 8% to 16%. If you look at the second sector like pharmaceuticals, during this time frame, last 17 years, pharma exports became 6 times. So what happens? Whenever any sector gains a scale, you become globally competitive. And when you become globally competitive, you add growth to the domestic economy because you are into the virtuous cycle of employment generation, then consumerism, and then more scale and more efficiency, and therefore becoming more competitive and more market share, and that cycle continues. The good part of India is India is adding more wheels to its vehicle. The same efforts the government is taking now on, for example, electronics as a segment. And this segment is going to be $75 billion exports by 2025, just in next 3 years. 8 times growth. I'm saying in 3 years, 8x. IT sector did 16x in 17 years. I'm saying electronics from 15 or less than 8 will become $75 billion just in 3 years' time. If you look at the specialty chemical, will also become $75 billion in just 3 years. What I'm trying to say is that India is changing rapidly, and India is going to become bigger and better. And as India becomes bigger and better, the question what investors should probably ask themselves is that can corporate India growth, which was like 9% from 2009 to 2023, just 9% below GDP growth actually, can it become 12, 15, 18, 20% growth? And probably the answer, if you ask my personal view, is a reassuring yes. There is a possibility that the corporate India growth can be strong double digit, anywhere from 12 to 18%. And if that happens, then remember 2003 to 2008, when Sensex became 5 times in 5 years, and the earnings grew by 24% compounded growth. The question is, are we entering into that golden era? Because then the returns can be much higher than what is normally talked about by all of us as a fund manager community. We keep saying, like Prashant said, 11, 12, 14%. The point is, probably the country is now becoming bigger and better. We are going to get scale, we are going to get efficiency, and that will drive the better and stronger and resilient economy as well as earnings growth, and therefore probably the better returns in store for the long-term equity investors.
Thank you, Rajesh. I think, we are very lucky to be born in India, and times ahead are quite interesting, and absolutely we all firmly believe in the same. But, within that, we are in this profession and our clients look for alpha. And my next question to Sunil, Sunil, you have founded Abacus on the promises of alpha, and so far Abacus has been kind of delivering alpha, and hence this foremost question to you. What has happened that in the entire space of products available today, there are hardly funds which actually have been able to deliver alpha over, say, last 4 or 5 years. And that is where there are many HNI investors who kind of have started to believe that probably investing large corpus of the portfolio to ETFs or index funds at least saves them costs. Because at the end of the day, it happens that, you may keep paying larger fees to active fund manager, but seldom alpha comes. But now, obviously, we know that times ahead of us could be very good, very interesting. So what is your piece of advice to these clients for next 5 years? Should they kind of select active fund managers over ETFs or index funds, or they are right in their thought process? Or if you put yourself in such investors' shoe, how will you approach such decision making over the next 5 years?
I think it's a very simple answer. The existence of Abacus and my friends on the panel and their companies are completely cognizant on generating alpha. If you're not able to generate alpha consistently, I don't think most of us would exist, because, as you rightly said, then we don't. Then investors don't need us. See, from an investor's perspective, I think what investors have to look at is returns net of fees. And as long as returns net of fees are compared, whether with within the peer group, within international funds, and within the ETFs or the passive funds, I think the answer is very, very clear, and it is very logical. As you rightly said, why would someone pay fees if post fees your returns are going to be lower? Coming to India as a country, see, India is still a growing economy. And to some extent, India is an economy which grows because of entrepreneurs, and to some extent, despite the government. And when you have such wide and diverse sectors present, and so many listed companies, and many more coming into the mainstream in terms of getting listed, new sectors, new themes, new companies, I think if you dig deep and if you're willing to do that extra effort of trying to meet companies, find companies which are not widely tracked by the analyst community, which still have not come into the large indices, which leads to some wide swing movements, I think there is enough scope for creating alpha. And as I said, we will not exist if we don't create alpha. The other thing is many times, and I've seen this over the last 25 years of investing, maybe more, there is a comfort which a portfolio manager gets into investing in well-known names. Now that comfort leads to index hugging returns. Obviously, if you are looking at a large cap fund, which is index plus minus, then what you are saying might make sense that, why should we bother about going in for actively managed funds when the returns are just the index hugging returns. But I think if you are able to or willing to put your neck out and say that every investment decision which we do, which is what we do at Abacus, is going to be individually sort of analyzed and whether they can make returns higher than what otherwise would be the case. I think over a period of time, you are still in a position to generate alpha with the economy still growing at upwards of 6-7%. So I would say that if you are a longer term investor, you still have a lot of room and active funds would be the place to be in.
Sure, Sunil, I think, this was quite insightful. Moving on to you, Prashant, there is another question that is always on minds of investors. We are wanting to kind of understand from their point of view, and that's why, I'm asking this question. And since you in White Oak now have all the three product structures, be it mutual funds, be it PMSs, or be it AIFs, and I assume, I could be wrong, you can correct me if I'm wrong, that the research team would be same for all the three product structures. Now, the inside story of how ultimately you as fund managers take decisions in kind of, adding stocks in these three respective structures. And from investors' point of view, an HNI investor who has a large corpus to invest, long-term horizon to invest, he has a belief on India growth story. Now, when he selects between PMS, AIF, and mutual funds, especially maybe between, say, mutual fund and AIF, right? So does it really make a difference in selecting between, say, AIF and a mutual fund when the pursuit is alpha? Or, it is like alpha is dependent on other factors and product structure does not matter at all?
Certainly, Kamal, this is a question that I get very often on whether PMS is better than MF or AIF is better than MF. At the 50,000 feet or at the conceptual level, the product structure, the packaging, the portfolio does not matter in determining the returns. If the portfolio has a certain same mix of, let's say, weights in stocks, then the portfolio doesn't know whether it is structured as a PMS or a MF. It would deliver same returns, adjusted for whatever the tax timing and differences would be. However, I think where the difference is more generally in the industry, in PMS and ourselves as well, between, say, PMS AIF on one hand and MFs on the other hand, is the risk tolerance to which those are managed, and rightly so. See, in MFs, retail investors don't have a choice. They usually come in MF only because of the minimum requirements. And risk tolerance, it is assumed, one can question whether it's a fair assumption by the industry, but the risk tolerance for retail investors is assumed to be somewhat lower than that of HNI. Now, in AIF PMS, it is assumed that HNI has a higher risk tolerance, though in my experience, that may not necessarily be the case. There's an entire range. Some HNI, ultra HNI investors might have risk appetite that is lower than the average retail investor as well. So it's inappropriate to club them all together as HNI having higher risk appetite. But at least in case of HNI, they have a choice. They can do MF, PMS, or AIF. Yeah, since they have a choice, it's just been, I think, perpetuated that for HNIs, PMS and AIF are better, because they have the choice to do so. But depending on the risk appetite, it may be that for certain HNIs, it's better to stick with mutual fund, which are more risk aware, whereas those who have a higher risk appetite and can endure the volatility of alpha to a greater degree, then they might choose the AIF PMS structure. And again, it is not that every AIF PMS or on average AIF PMS would do better than MF. Just like in MF industry, there's a wide range of performers. On average, they may perform in line or average or below average or above average compared to the benchmark. In AIF PMS also the entire range of such outcomes. I think the time horizon and risk appetite both becomes very crucial. It is certain investors may expect high alpha every month, every quarter, every year, or every 2 years or 3 years. And then they'll say, oh, well, PMS is supposed to be outperforming MF. But over the last 3 years, my MF has underperformed PMS. So it's very similar to how we all may agree today that equities in general provide higher returns than fixed income. Yeah. Today, we all agree, and probably most of the audience would agree. But I'll bet you 2-3 months ago, many of those same people who today agree equities give higher return than fixed income would be thinking, is it really fair to assume equities give higher return than fixed income? Because they were complaining over the last 2 years, fixed income has done better than equities because equities had a bit of a lull period. So equities may, just as equities may go through an extended period of underperformance relative to fixed income, like from 92, Sunil mentioned about the 92 boom, from the peak of 92 to somewhere around 2004, 2005, or maybe until 2006, equities underperformed fixed income for over a decade from a point to a point. Yeah. So at that time, a lot of people would have believed fixed income delivers higher return than equities. But then if you take it over very extended period of times, rolling periods, then equities has delivered higher return. So risk appetite and time horizon, which are also somewhat interrelated, are important consideration on which investors it is a better fit to invest in AIF PMS.
So Prashant, so basically, higher risk, higher returns, and longer horizon kind of withers risk, and hence products like alternates, PMS and AIF products are more conducive to generate higher returns for high risk, I would say, accepting investors over a longer period of time. Right. So, moving on to you, Rajesh, there is another thought that, investors always have, or a matter of confusion investors always have while kind of creating their portfolio, and that's between large cap, mid cap, small cap. And since you have been managing a flexi cap and a multi cap fund for almost 13-14 years, and recently over the last 2 years, you have started a mid and small cap focused fund. I remember when I met you, in 2019 for the first time. At that point of time, you were kind of very convinced that one should be investing in a multi-cap fund. I remember that. But then you have recently launched, I think 2 years ago, your small and mid-cap fund, which is doing quite well. Now the question is next 5 years. So we want to understand from you, where is more opportunity? Because when we say that India's economy over, say, next 3-4 years will grow from 4 trillion to 5.5 trillion, obviously maximum contribution will come from top 100 companies, which is large caps. But from the point of view of investors making more wealth, where should investors be more biased towards?
Really, Kamal, what has happened is that when we look at internally any business, the one is, of course, the market cap bucket. But more interesting bucket is the profit size bucket. Instead of doing the market cap bucketization, we do the company segregation depending upon its profit bucket. Now in India, there are 5,000 plus listed companies. And out of that 5,000 listed companies, there are only about 600 companies, which makes net profit in excess of 100 crores. Correct. So let's put 100 crores as a benchmark, because that means you have done something really well to be the great in corporate India, to be the top 10% or 15% of the listed universe. We keep that as a benchmark to decide whether the company is large or mid or small on the profit size basis. But the definition of market cap is, as per the regulation, only top 100 by market cap is called large cap. It means out of the 600 companies, only 100 are classified as a large, which is 18%, roughly 17-18%. It means there is a 82% of the companies are into mid cap and small cap, although the companies are large, but their market cap is defined as mid cap and small cap. And when we saw that discrepancy, at Alpha Equity Advisors, we follow the 3M approach: market size, market share, and margin of safety. And we buy oligopolies, we buy monopolies. we found that many companies and many sectors, they became mid-cap and small-cap because of the definition. So say, for example, the entire plywood sector became mid-cap. There are only 2 companies in plywood, both became small-cap. Entire wire and cable sector became mid-cap. There are 2 listed companies, largest players, they both became mid-cap. Entire luggage sector, there are only 2 players in India in the listed space, both became mid and small cap, and many more such examples. So when we saw that all these companies are actually great companies that fit into our 3M framework, but due to the new definition, they fall into mid and small cap space, we decided to launch a new plan, which is called AAA Budding Beast, which is a mid and small cap focus. But not a single company is a micro company generating 10 crores profit or number 15th or 18th in market share. So we said this is a super opportunity to create the higher risk adjusted returns, because that's what our mandate is from our investors. And we believe that this space will definitely outgrow the mega cap, because mega cap can deliver earnings growth of say 15, 17, 18% as a generally speaking. And surely this kind of a bucket can generate earnings growth of say 18, 20, 25%. Of course, the volatility is going to be a little bit higher. You require stomach to absorb that volatility. And hence the patience is very important, as your risk appetite needs to be a little bit higher. You need to have a longer time horizon because at times mid and small cap crash. So at that time, you don't need to do panic. You need to do top up. So opportunities are both, whether it's mega cap, large cap, mid cap, small cap, micro cap. But we believe that if anybody, of course, has a longer term time horizon, then this kind of a bucket, our definition of mid and small cap bucket, definitely can throw bigger opportunity to generate alpha, provided you have a little bit longer time horizon, provided you have a stomach to absorb a little bit more volatility.
Sure, Rajesh. I think, longer the time horizon, higher the risk appetite, and ultimately, obviously, one will build more wealth. Moving on to you, Suni. Another aspect, that from again point of view of investors is timing the market. I have always seen, Abacus has been able to deliver alpha, probably because Abacus has been lucky in terms of launching products at right times. Maybe you are lucky, or maybe, you are thoughtful. I have in my last 18 years of career always learned that time in market is more important than timing the market. But I think, timing is also important, and it has worked for you for sure. So this question to you, were you lucky or were you kind of thoughtful, and what are your views in this regards? Does timing matter when the pursuit is alpha?
No, I'm thankful to God that I've been lucky for the last 30 years. And I hope I am lucky for the next 20 years also. So I don't know how to answer this. See, obviously, when you look in hindsight, you do feel that if I would have invested during COVID, or when I had invested in during Lehman crisis and all, it would have been phenomenal. But let me tell you, first of all, I think we always have the philosophy of having some cash always. So whether that is 5% or 10%, that is the only cash call which we take, except when we launch a new fund, because then we are very thoughtful. We are building a new portfolio, and we are a little bit value conscious. Otherwise, time and again, it has been proven that it's almost impossible to time the markets to perfection. I think what we can time is our investments in particular stocks, and for that you need discipline. So what typically happens is, in a momentum kind of a market, which we have seen over the last 2-3 months, human beings are human beings. We get carried away. So I always say this: in a bull market, the time taken to research reduces, the bet size increases. And in a bear market, the time taken to research increases. Same company, we keep on analyzing time and again, and the bet size decreases. And I think that is what you have to overcome. Having said that, I just give an example. Suppose if you are investing in a company where you think the profit growth can be like 18% over the next 4 years, that means the profit doubles in 4 years. Even if you go wrong in your timing by 5-10%, I don't think the returns on a 4-year basis are going to be significantly different. So yes, to some extent, you might be lucky if you entered the market right at the bottom, but that would be like 2%, 5% of your portfolio. It is not going to be like 100% of your portfolio. The point which any investor should keep in mind is what is the outlook on the economy going forward. So, whether the Nifty is at 19,000 or 18,500 or 19,500, is it going to make too much of a difference if you're looking at 100% return over the next 4-5 years? Instead of 100, you'll end up making 95% return, if you are able to time that 5% to perfection. And I think as long as your view on the path going forward is positive, I don't think you should try to time it too finely. The only one disclaimer I would put here, having seen and met investors for decades, is that it gives them mental comfort if they invest in parts. And therefore, just for mental comfort, we always say that, if you feel that the market is overheated, just for mental comfort, divide it into 2 or 3 parts and invest. I don't think it is going to make too much of a difference to their returns, but it will give them a lot of mental comfort, and mental comfort is also needed, because if you don't have mental comfort, you'll end up exiting at the wrong time. So that is the only advice I can give.
Sure, Sunil. I think, this was again quite interesting reply. Moving on to you, Prashant. Another aspect from investor perspective is, does macros matter? Because you, particularly, I have always heard maintain that macros are only for entertainment. And, macros, from your point of view, you have always maintained that do not matter. It is the micros, the fundamentals of underlying businesses that matter. And over last 2 years, we have actually seen, markets coming under grip of macros. Those fund managers who were able to predict that interest rates will rise because of inflation, kind of, change their style from growth to value, have been able to maintain, alpha in the portfolio. But obviously, some of those fund managers who are sticking to micros and fundamentals have seen the painful period of last 2 years. So are your views still intact that macros do not matter, or you kind of want to give some kind of learning or some kind of, I would say, difference in the opinion? You're on mute, Prashant.
Sorry, I was saying thanks for the question. I think it's similar to macro is, or market timing is also a macro call, right? And I would say what applies to market timing applies to all macro calls as well. So I would just change a couple of words from what Sunil mentioned, and he summarized it quite well. He said that it is almost impossible to time the market to perfection. I usually say something similar, but drop 2 words. So I say it is impossible. So it is not almost impossible, but it is impossible to time the market. Forget about perfection. So it is just impossible to time the market. And similarly, it's our belief, and I've been investing personally or professionally for 35 years, that it is impossible to do market timing or macro top down, particularly if, it's like micro and macro are 2 very different sports. And if, like say cricket or football, even if you assume that macro, there was some way of, there's so many people who are macro investors, and there could be some who are able to generate alpha in macro. But you can't, there's no example of a sportsperson being the best in football as well as the best in cricket. So to pick your sport. If you are a stock picker and you say, okay, you're a cricketer, I also be able to play football at the national level, there's just no example of such. Now, what happens is, and we did this at the start of last year, this year actually, just 6 months ago, Kamal, at our conference, where there were about 250 odd people. Assume there are 1,000, so 250 people. Let's take 250 people. I flipped the coin 8 times and asked each one of them to note down what their prediction was before the coin flip. And how many got all 8 right, how many got 7 right, how many got 6 right, and so on and so forth. Now, statistically speaking, out of 250 people, 1 should have got all 8 right. Yeah? That is just, if you do it many, many times, 8 coin flips amongst 250 people, 1 person on average would get right. Coincidentally, it so happened in our situation also, one person did get it right. 8 out of 8 coin flips were right. So I prompted to them, well, that means you have some predictability power on coin flips. Have you tried your luck with market as well in predicting the market? So obviously with coin flips, everyone now knows enough to understand coin flips are complete game of chance and 50% will be right, 50% wrong. But when you have 8, if you were to get the market right 8 times, or if you as an observer see a particular manager get the market right 8 times, you might be led to believe that that individual has a market timing capability. Whereas it is just statistical outcome that if 250 managers are trying to time the market, one of them would get it right 8 times without any skill at doing so. And that's our belief with all macro events. So just like 50% right, everyone or most people would have gotten 50% right? So 50% wrong. So similarly, those who might have got this one right, where growth, value, what you described, you have to look at what their past track record has been. If they have a track record, did they get COVID right? Many of those people whom you find to have done well between this growth value, if you look at that COVID time, they would have gone into cash in March 2020. Or they would have bulked up big time into pharmaceuticals and staples, believing the world's going, doomsday scenario, everyone would be just eating medicines and washing their hands with soap. Yeah. And those turned out to be extremely poor performers over the ensuing 2-3 years. So you can't just take one instance of a manager's macro call because it's like taking one coin flip. Someone's got calls heads and gets it right. Doesn't mean that individuals got a predicting power on coin flips. And same is true for macro, Kamal, in our view.
So Prashant, I think explained beautifully. Moving on to you, Rajesh, this is the last question, for this panel discussion. We all of us believe equity markets have great potential for wealth creation in future. And I try to kind of ask almost all questions that come to my mind from investors' perspective with regards to they making well-informed investment decisions and choices. The last question, which I have on my mind, we have heard many stories of, stocks like HDFC Bank compounding at 20%, Asian Paints, Nestle, Titan, Bajaj Finance, Page Industries, and so on. And obviously, these are all stories that today we call them as consistent compounders. Now, over next, say, 5 years, 10 years, I still see some of these stocks there in many flexi-cap portfolios. But as an investor, if an investor is looking for alpha, what is the role that these stocks kind of play, or what should be the kind of, I would say, attribution or contribution or allocation to these stocks in investors' portfolio? Because in a growing economy, in today's environment where interest rates are also high, some of these stocks look to be expensive. And many clients have kind of, I would say, 70-80% allocation to some of these stocks, and still they are looking for alpha. Now, from your point of view as a fund manager, when you are managing money in a flexi cap fund, how do you attempt to use these stocks judiciously in your portfolio management?
Thanks for that question, Kamal. I think very interesting question. First of all, there is nothing called consistent about consistent. Please understand. Every business goes through the business cycle. For example, if you have invested in Unilever in 1999 and you hold for 6 years, it actually was flat for 6 years because of the price war with Nirma. Every business goes through the cycles. Am I right? And whether we like it or not, the business cycle is reducing. If you look at the McKinsey report, earlier the business cycle, the longevity of the business was 90 years. Now that is reduced to less than 18 years. 75% of Sensex has changed in the last 16 years, 75%. And many of those companies which are blue chip companies, they went down 90%, 90, forget compounding, they destructed wealth despite they were the largest companies like MTNL, Bail, and many more such companies. We have a full list, am I right? So you should never be complacent. What is important is not to look at what was the market cap growth for last 20 years, but please look at what was the earnings growth for last 10 years. At times, the market cap growth is running ahead of earnings, but then it will come down because in the long term market is mirror of earnings. So very, very important, we at Alpha Equity Advisors, we believe in two things. So first, the quality of companies. The growth is important. And second is the agility, because the business cycle keeps changing. The pharmaceutical company, for example, during COVID, We bought, for example, pharma companies. We thought it will go up 50, 60% in 3 years. But it went up 60% in 3 months, 4 months, 5 months. Am I right? It is discounting as if everybody is going to eat medicine for the next 10 years. Really, that was not the case. So we have sold pharma companies, not because companies were bad, but because the valuation went through the roof and everybody extrapolated those numbers. Same thing happened to IT sector. Last year, when the war was announced, it was clear the Fed was against inflation. But everybody thought that IT companies will keep growing at 30% for the next 5 years. Clearly, that was not the case. So you need to be agile. You need to move out and you need to find where there is a growth. And of course, you need to buy at a reasonable valuation. So the answer is whether it is a company A or company B, whichever company you mentioned, don't assume that it will continue to compound for the next 10 years just because they were super companies for the last 10 years. In fact, many of those companies didn't deliver even India GDP growth in profit terms. The companies which you mentioned, few of them, they grew earnings by only 8% when economy was growing at 12%. But the market grew by 22%. So clearly, it will come down, am I right? So never assume that today's monopolies and today's mode will remain tomorrow's mode. You need to evaluate your portfolio on regular basis. You need to make sure that the growth, what you factored, is going to come and will remain for next 12 months, next 24 months, next 36 months. You need to check at what valuation you have bought and are we at a margin of safety or not. And based on that cycle, because remember, every business is a cycle. Please remember this. Cycles are getting reduced and therefore the swings in market are becoming extreme. Take volatility as your friend, be agile, be nimble, and keep changing depending upon where do you see the growth. That's basically the final mantra from my side. The causality is going to be the ultimate winner. And that's what we believe at Alpha Accurate Advisors.
Thanks, Rajesh. We have last 1 or 2 minutes, Prashant, and I want you to kind of address the final question, which investors always have on their mind, which is diversification versus concentration. Your portfolios are always mostly kind of, I would say, over diversified or well diversified, but still, you have been able to kind of manage to give decent returns. In the current context of equity markets, we know you also address that Indian equity market throws a lot of opportunities because of market breadth, and hence a well diversified portfolio can also generate alpha. But having said that, when you put yourself in investor's shoe, how will you address this particular question?
See, I think 1 or 2 minutes, a little bit short for me to do proper justice. So I'll just give some analogies, and maybe a more detail. I've answered this question in my last 17 years of professional career managing India money. I've answered this question 1,700 times. So I have been very firmly a believer. The number of names in the portfolio has no cause or effect relationship with performance. It is one of the biggest myths. We talked about PMS versus MF and all that. That's also a myth created by, it's like go-to-market strategy of many PMS houses or MF houses to create these myths. Similarly, I think a small number of concentrated portfolio, focused portfolio better than others. It's a myth created over decades, not just by Indian MFs or Indian PMS, but globally. But there is no evidence to support this. If there is evidence of concentrated portfolio doing well, there's also evidence of very, very diversified portfolios doing equally or even better. We did a last quarterly webinar for that White Oak hosted. We focused on this particular aspect and will welcome you or anyone else who'd like to listen to that. About the myth of concentrated portfolios was the title of that. We gave an example of Peter Lynch, which most of the listeners here would have heard of. Peter Lynch, when he was assuming the portfolio management role, he was asked by Ted Johnson or Ned Johnson, who was the family of Fidelity, founder family of Fidelity, who was handing over that portfolio because Ned was managing that I think there are too many names in the portfolio. And he had 40 names. You should cut it down to 25. And this is from the book One Up Wall Street, which I recommend everyone to read this section. How many stocks are too many? And what Peter Lynch says is, I listened to Ned. I went out and did just the opposite. Within the first 6 months, I raised the number of names to 60. In a year to 100. And in a year and a half to 150. Over a 13-year time span, that Peter Lynch generated 27% dollar return compared to 14 of the benchmark, beating by 13 percentage points. Peter Lynch's average number of holdings in the portfolio were 200. 200 names in the portfolio. And see, we ourselves, so that is one example that I provide, because if we just provide our example, people may not be able to relate, because who are we? But Peter Lynch, we all, obviously, Buffett and Lynch and all these are cult figures. So there is this actual example from US market where over a very prolonged period of time, a manager has generated higher return than anybody else in the peer group by running a, on average, 200 name portfolio. And we have, for the last 16, 17 years, if you include my tenure at my prior firm, I have run average portfolio number of stocks would be during this time approximately 80 names. So I repeat, number of names, turnover, all these various things that people often quote, they are just byproducts of a manager's style of investing. They are not the end goal. End goal is to generate highest return. And these things are byproducts. They are neither the end goal nor the means to achieve the end goal.
Sure, Prashant, thank you so much. I think, it has been quite an insightful session. And I will just sum it up by saying that, when Aishwarya initiated this session, she had mentioned whether we are in a bubble or it's a long-term bull run. It's I would say, more than a long-term bull run. Definition of long-term could be 5 years or 10 years, because obviously all of us firmly believe in India and in equities and asset class. But yes, one needs to have a long-term horizon. And some of these alternative investment funds are meant for high-risk investors who kind of deserve to take high risk and at the same time who aim at higher returns. Thank you, everyone. And thank you, both of you. Over to you, Aishwarya.
Thank you, Kamal. Thank you, Aishwarya.
Thank you very much to our eminent panelists, Mr. Rajesh Kothari, Mr. Prashant Khemka, and Mr. Sunil Singhania. I think those were very, very impactful insights rendered. Thank you so much for the valuable insights. And I would like to really thank Mr. Manoj Shah once again for wonderfully steering this session as well.